You've probably heard the advice 100 times. Just go Roth. A Roth is always better. And it sounds smart, so people nod along. The problem? It's wrong about half the time. And the other half, people get so tangled up trying to decide that they freeze and open neither. Which is the worst choice of all? So let's clear this up for good. Because here's the thing nobody says plainly. A Roth and a traditional IRA are not really two different accounts. They're the same investment, taxed at two different moments. With a Roth, you pay the tax now. Your money grows tax-free, and you withdraw it tax-free in retirement. With a traditional, you skip the tax now. You get a deduction today. It grows, and then you pay tax on the way out. That's it. That's the whole difference. Tax now or tax later, which means choosing between them isn't a personality test. It's a single bet. Will your tax rate be higher today or higher in retirement? Get that one call right, and the gap between these two accounts can be worth tens of thousands of dollars by the time you stop working. So we're going to settle this in 5 rounds. By the end, you won't be guessing. You'll know exactly which one fits you. Let's start with the one real difference, because everything else flows from this. Picture planting a crop. With a Roth IRA, the government taxes the seed. You take money you've already paid income tax on, you plant it, and then, this is the magic, everything that grows from it is yours, completely tax-free. The entire harvest, no matter how big, comes out untouched in retirement. With a traditional IRA, it's flipped. The government lets you plant the seed tax-free. You even get a deduction, so you skip the tax this year. Your crop grows, but when you finally harvest it in retirement, every dollar you pull out gets taxed as income, including all that growth. So Roth taxes the seed. Traditional taxes the harvest. One taxes the small amount going in. The other taxes the big amount coming out. Same money, same investment, same market. The only thing that's different is the moment the tax bill arrives. Now your instinct probably says, obviously I'd rather tax the small seed than the giant harvest. Roth wins, easy. It's the most natural reaction in the world. Hold that thought, because the size of the harvest isn't actually what decides this. And that's the trap that catches almost everyone. Feels like a bigger pile of money getting taxed must be the worst deal. It isn't, not by itself. In the next round, I'll show you the math that proves it, and why that gut reaction quietly leads people to the wrong account. Here's the surprise that breaks the Roth is always better myth wide open. If your tax rate is exactly the same when you put the money in as when you take it out, the two accounts tie. Perfectly. You end up with the identical number of dollars either way. Let me show you why, because it's actually beautiful once it clicks. Say you have $1,000 and you'll be taxed at 22%. With the Roth, you pay the tax first. That's $220 gone. So $780 gets invested. Let it grow tenfold, and you walk away with $7,800, all tax-free. With the traditional, you invest the full $1,000, no tax yet. It also grows tenfold to $10,000, but now you pay 22% on the way out, $2,200, leaving you with $7,800, the exact same amount. That's not a coincidence, it's just multiplication. Taking 22% off the front or 22% off the back gives you the identical result, because the order you multiply numbers in doesn't change the answer. So when the rate doesn't change, there is no winner. It's a wash, which means the whole game, the entire reason one beats the other, comes down to one variable we haven't touched yet. That one variable is the real tiebreaker, your tax rate now versus your tax rate later. Since the accounts tie when the rate stays flat, the winner is decided entirely by which direction your rate moves. And there are only two possibilities. Possibility 1, your tax rate is lower now than it will be in retirement. In that case, you want to pay the tax now while it's cheap and lock in tax-free growth forever. Lower rate now means Roth wins. This is the classic case for someone early in their career. You're in a modest bracket today, and you expect to earn more and be taxed more down the road. Possibility 2, your tax rate is higher now than it'll be in retirement. Maybe you're in your peak earning years, sitting in a high bracket. Then you'd rather skip the expensive tax today, take the deduction, and pay later when you're in a lower bracket. Lower rate later means traditional wins. So the real question was never which account is better. It's, when will I be taxed less, now or later? Tip the scale toward less now, go Roth. Tip it toward less later, go traditional. That single forecast is the whole decision. Now, the rate bet is the core of it, but the Roth has a few hidden edges that can tip a close call in its favor. 4 of them are worth knowing. First, tax-free growth removes uncertainty. With a Roth, you know exactly what you'll get. What you see is what you keep, no matter where tax rates go in 30 years. The traditional's final value is always a question mark, because future you doesn't control future tax law. Second, no required minimum distributions. With a traditional IRA, the government eventually forces you to start withdrawing and paying tax, whether you need the money or not. Those are called RMDs. A Roth IRA has none. Your money can keep growing, untouched, for as long as you like. Third, flexibility. With a Roth, the contributions you put in, not the earnings, just what you contributed, can generally come back out without taxes or penalties if you truly need them. That makes it quietly more accessible than people assume. And fourth, it's simply built for the young and the lower bracket. If you're early in your career, your tax rate is probably the lowest it'll ever be. Paying tax now is a bargain. So, when would you ever skip all that and go traditional? When its one big edge outweighs the Roth's perks. And that edge is the upfront deduction. Here's the move most people miss. When you contribute to a traditional IRA, you lower your taxable income today, which means you get some of that tax money back right now. And that returned cash isn't meant to be spent. It's meant to be invested too. Think of it this way. Say you can afford to put in the full contribution. In a Roth, that money is already taxed, so the full amount is working for you, but you paid the tax to get there. In a traditional, the deduction effectively hands you back a chunk of cash today. And if you invest that refund alongside your contribution, you've got more dollars working in the market right now, compounding for decades. That's the high earner's logic. If you're in a steep bracket today and you genuinely expect a lower one in retirement, the traditional lets you deduct expensively taxed dollars now, invest the savings, and settle up later at a gentler rate. You're shifting your tax bill from a high-rate year to a low-rate year, and pocketing the growth in between. The catch, of course, that deduction isn't forgiven, just postponed. You'll pay the tax eventually, ideally when it costs you less. So let's settle it. It was never Roth versus traditional. It was always tax now versus tax later. A single bet on where your tax rate is headed. Run the test on yourself. If you're young, early career, or sitting in a lower bracket today, your rate is likely to rise, so lean Roth. Pay the cheap tax now and let it grow tax-free, with no forced withdrawals and easier access along the way. If you're in your peak earning years, in a high bracket now and expecting a lower one in retirement, lean traditional. Take the deduction, invest the savings, and pay the gentler tax later. And if you genuinely can't tell which way your rate will go, you're in good company. Plenty of people simply split the difference and contribute to both, hedging the bet across now and later. There's no wrong answer there. The one truly wrong move is the one we started with. Freezing, picking neither, and leaving years of tax advantage growth on the table. Just make the call and start. If this finally made these two accounts click and turned an impossible-feeling choice into one simple question, hit subscribe. That's exactly what this channel is for. The money stuff nobody ever bothered to explain. Next, the 4% rule. How much you actually need invested to never work again. I'll see you there.